Hey everyone, welcome to this explainer. Okay, today we are diving into what is honestly one of the most mind-boggling corporate mysteries in recent history. I mean, this story, it feels like a Hollywood thriller, but every single detail is absolutely 100% true. We're talking about the spectacular rise and the totally devastating fall of WeWork. $47 billion. Just try to wrap your head around that number for a second. For a brief, wild moment, WeWork was the absolute darling of Silicon Valley. But here is the massive paradox we're looking at today. This company, valued at $47 billion, basically collapsed overnight. And the wildest part of the whole shebang? They did it without ever turning a real profit. No way, right? Right, so that naturally brings up some pretty massive questions. Like, how on earth does a $47 billion company implode without ever actually making money? And how did all these highly experienced, super connected investors just keep pouring billions and billions into a venture that was literally bleeding cash? More importantly, if you're interested in entrepreneurship, what were the fatal mistakes that ruined what was, at its core, a truly revolutionary idea? Let's decode the real story behind this disaster. Section 1. The Co-working Revolution. So, to really grasp the sheer magnitude of this fall, we actually have to go back to their brilliant beginning. Adam Neumann and Miguel McKelvey founded the company in 2010, right as the gig economy was waking up. You know, instead of getting locked into some depressing 10-year commercial lease, small businesses could just rent a gorgeous glass-walled office on a month-to-month basis. By 2014, this concept was exploding. They were offering free coffee, craft beer on tap, which was huge at the time, and a built-in community vibe. Fast forward to 2018, and it was a massive hit. Everybody from solo freelancers to giant corporations wanted a piece of this energy. Section 2. Fueling the fire. Now, what happened next took them from a humble, cool startup to just an impossibly hyped juggernaut. The narrative completely shifted. It wasn't about renting desks anymore. They claimed they were elevating human consciousness in the workplace. Seriously. They kicked off this breakneck global expansion, driven by astronomical funding rounds, most notably a massive multi-billion-dollar lifeline from SoftBank. Investors were totally spellbound. They genuinely believed WeWork was single-handedly dictating the future of work. The hype was basically a roaring fire, and billions in venture capital, that was the gasoline. And right at the center of that fire was founder Adam Neumann. Now, on one hand, you have his wildly charismatic, vision-driven leadership. He built this incredibly unique, almost cult-like company culture. I'm talking mandatory summer camps fueled by tequila that made employees feel like they were genuinely changing the world. But on the flip side, you have his completely unchecked, aggressive ambition. Pushing for growth at absolutely any cost creates an inspiring vibe, sure, but when you completely detach that from financial reality, you are setting the stage for disaster. Section 3. Warning signs emerge. Because, quietly in the background, a very different reality was playing out. Looking from the outside, the success markers were all there, right? Rapid hiring, aggressive global expansion, that highly publicized culture. But the internal reality check was honestly pretty grim. All that rapid hiring, it was masking incredibly weak corporate governance. That global expansion was built on locking into super expensive 15-year office leases, while only getting month-to-month commitments from their own tenants. And to hide their wild, out-of-control luxury spending, they literally invented a fictional financial metric. They called it community-adjusted EBITDA, basically just to make their massive gaping losses look like profits. When you strip it all away, the fatal flaw in WeWork's business model really comes down to this. Massive injections of private funding were acting as a life support system, completely masking staggering, cavernous operating losses. Think about it. They were renting expensive real estate long-term, slapping some nice paint on it, and then subleasing it short-term for less than it actually cost them to operate. The math simply did not work. At all. But that endless river of private cash, it kept the ugly truth hidden from the public eye. Section 4. The Valuation Illusion. Okay, so you might be wondering, if a company is bleeding cash like that, how on earth does it get a $47 billion price tag slapped on it? Well, to understand that, we have to look at how startup valuations actually work. A valuation is really just an estimate of a private company's worth, and it's based entirely on investor expectations and the latest round of private funding. It is not necessarily based on current profitability. Think of it kind of like this. Imagine you're selling a tiny rundown house, but you have a beautiful blueprint for a massive mansion on that same lot. A private investor comes along and buys a 10% share of your rundown house for $1 million because they firmly believe that mansion is getting built. Suddenly, on paper, your tiny house is valued at $10 million, but the mansion hasn't been built, and the roof on the little house is literally caving in. That was WeWork. And this brings us to a hard truth. High valuations absolutely do not always reflect sustainable businesses. A valuation is essentially just a narrative. It's a story told by investors about what the future might look like. But a business still has to, survive in the present. If the underlying business model can't actually generate a profit, a sky-high private valuation is nothing more than a fragile illusion, just waiting to shatter. Section 5. The brink of collapse. And oh boy, did it shatter. This is your classic corporate Icarus tale, flying way too close to the sun on wings made of venture capital. The downfall happened in a pretty catastrophic chain of events. First up, the failed IPO. When WeWork finally had to open the books and show their true financials to the public, the market violently rejected it, and poof, that $47 billion valuation vanished into thin air. Second, SoftBank tried this humiliating rescue attempt just to keep the lights on. Third, we saw the dramatic exit of Adam Neumann. He was ousted from his very own creation, though shockingly, he managed to walk away with $1 billion golden parachute. Insane, right? And finally, the ultimate tragedy, filing for bankruptcy. So, we've seen the brilliant rise and the catastrophic collapse. We've seen how unchecked ambition and the illusion of a massive valuation can blind even the absolute smartest investors in the room. But when the dust finally settles on a $47 billion crater, it leaves us with a pretty terrifying question. Was WeWork just a one-off anomaly driven by eccentric leadership? Or is it a glaring mirror reflecting a much deeper, systemic flaw in how we value modern startups? We're going to unpack the real-world fallout and the crucial lessons every entrepreneur needs to learn in part 2 of this explainer. See you there.
Welcome to this explainer. Today, we're diving right in to conduct a complete corporate autopsy on the dramatic, almost unbelievable collapse of WeWork. Just a few short years ago, this company was absolutely celebrated globally. It was hailed as one of the world's most valuable startups, literally a unicorn among unicorns, peaking at a massive $47 billion valuation. It promised to completely revolutionize the way we interact with modern real estate and office culture. But, well, we all know the story didn't end there. So how did an empire seemingly built on the future of work crumble so quickly? We're going to break it all down.
Here is our roadmap for today. We'll start with the failed IPO trigger, move through Adam Neumann's sudden departure, and track the path straight into bankruptcy. Then, we'll extract some essential business lessons, ask if they actually could have succeeded, and finally, look at the lasting legacy of coworking.
Section 1. The failed IPO trigger, moving from hype to reality.
So, shifting from private to public markets is kind of like turning on the bright fluorescent lights at the end of a party, right? Suddenly, you see everything. During the private funding era, WeWork was surrounded by this unbelievable hype. Investors totally bought into a charismatic vision, and in doing so, they comfortably overlooked some massive structural weaknesses and insane cash burns. But an IPO? That requires strict, highly regulated financial disclosures. You have to open your books to the entire world. And the second WeWork did that, deep investor concerns immediately surfaced about their actual profitability.
The domino effect here was incredibly fast. It literally unraveled in a matter of weeks. In week 1, the initial IPO filing makes their financials public. By week 2, those disclosures are getting heavily scrutinized by analysts and journalists all over the world. And what did they find? Staggering losses and highly unusual accounting metrics. This intense magnifying glass just created a total downward spiral. And by week 4, investor confidence was completely gone. Zero. The offering was pulled. In this case, basic transparency was the ultimate trigger for the collapse.
Section 2. Adam Neumann's departure, a leadership crisis.
Okay, so corporate governance issues rapidly escalated in the public eye. Those IPO documents revealed that CEO Adam Neumann had near absolute control, alongside some glaring conflicts of interest. I mean, he actually trademarked the word "we" and sold it back to his own company. You can't make this stuff up. So as the largest financial backer with billions on the line, SoftBank had to step in and intervene to stop the bleeding. This mounting pressure ultimately resulted in the forced executive exit of Neumann, a high-profile ouster that pretty much shattered whatever tiny bit of investor trust was left.
Section 3. The path to bankruptcy, compounding factors.
Now, it's crucial to understand that the ultimate decline was a compounded failure. It wasn't just one thing. It was a perfect storm of 3 massive, overlapping pressures. First, the COVID-19 pandemic instantly shifted market patterns, driving everyone away from dense offices. Combine that sudden shock with an absolutely crushing debt burden from their aggressive growth-at-all-costs expansion strategy. And finally, skyrocketing office vacancies. They were locked into these incredibly expensive long-term commercial leases, but their revenue from short-term tenants was just evaporating. It was a completely inescapable financial trap.
Section 4. Essential Business Lessons. Dissecting the Failure.
Let's map WeWork's specific flaws directly to the realities of business survival. Their reality of chasing exponential growth without any profits, that teaches us the absolute paramount importance of cash flow. You simply cannot subsidize losses forever. Their poor corporate governance reinforces the critical demand for responsible leadership and independent board oversight. And their structurally unsustainable model, borrowing long-term to lend short-term, is honestly a masterclass in why proactive risk management is non-negotiable.
Section 5. Could WeWork have succeeded? Analyzing alternatives.
While we can only analyze hypotheticals here, imagine for a second if they had chosen a different path. What if WeWork had pursued a slower, measured expansion? Actually making sure a region was highly profitable before moving on to the next. What if they had instituted better financial discipline and lower debt accumulation right from day one? With stronger corporate governance to check the founders' impulses, this pivot toward disciplined fundamentals might have actually created a highly successful, sustainable company, capable of weathering any economic storm.
Section 6. The Coworking Legacy. Influence Beyond Failure. So, despite this truly spectacular collapse, the failure actually provided invaluable insights. The rise and fall of WeWork acted as a real-time stress test for the entire venture capital ecosystem. And it proved to founders and investors worldwide that the underlying innovation of flexible workspaces still matters deeply. They popularized beautiful design, community management, and flexibility in corporate real estate. People loved the product itself, even if the financial container holding it was fundamentally broken.
The idea of coworking was not bad. It struggled because rapid expansion, financial decisions, and governance challenges created an unsustainable model. That quote really hits the nail on the head. The core vision was never the issue. Millions of people genuinely wanted to work in these environments. The fatal flaw wasn't the idea itself, it was the total hubris of the execution.
I want to leave you with this final, provocative thought to carry forward from this explainer. Are you building your business on strong fundamentals or just relying on a big idea? Always remember that long-term success depends entirely on managing growth responsibly, prioritizing sustainable economics, and actually executing on those fundamentals. A massive, world-changing idea is a phenomenal starting point for sure, but execution is what ensures survival. Thanks for joining me for this deep dive. Keep questioning the fundamentals of what you're building, and I will see you in the next one.